Okay, let's make a start. So, just a few quick housekeeping points before we do begin today's webinar. Today's webinar is being recorded, and don't worry, we will share the recording with everybody post-webinar. Do please keep your microphones on mute throughout this session, but if you do experience any technical issues, i.e. with sound, etc., if you could pop that into the chat and let us know, that would be very, very helpful. Do, as we're going through the webinar, submit any questions. We'd love to have interaction as we're going through the different sections. You can find the chat button under the More section. And if you are joining from a tablet or iPad, that will be under the Participants section. For those who do potentially need it, you can turn on captions throughout this webinar. That is located under the More tab. And now I'll introduce today's speakers. So first, we've got Peter Buck. So Peter is a partner here at Champion and he leads the charity team over in our Preston office. Alongside his professional work, he's been involved with charities from a young age, both as a director and through various committee roles. He brings more than 30 years experience working for non-profit organisations. But as well as audit and accounts, Peter has extensive experience in charity VAT, tax and legal structures, and is particularly passionate about helping charities present themselves effectively through their accounts. Joining Peter today is Paul Bell. Paul is a client director here at Champion and works closely with a wide range of charities. He brings more than 20 years' experience and deep insight into charity accounting, audit, and governance. He's also worked as a finance lead within a charity and currently serves as a primary school governor, so he understands both the operational and the trustee perspectives. And just a little bit about me as your host for today. So I'm Jen and I'm from TWA Marketing. We've supported Champion as their PR comms and marketing partner for more than a decade. So we support the teams over in Manchester, Chester, Blackpool and Preston. So without further ado, I'll hand you over, Peter, and we can get started.
Brilliant. Thanks, Jen. Well, good morning again, everyone. Now, whilst we can't see everyone, and I don't know if your cameras are on or off, we do have a list of participants, and it's great to see everyone who's been able to join us today. We really appreciate your time. There's a lot of demands on your time as charities, and we appreciate you taking this hour and a half today. Hopefully, we'll make it really useful for you. Now, the SORP then. It starts from periods commencing the 1st of January 26 and afterwards. So basically that's December 26 year ends, or more commonly it'll be March 27 year ends where it first applies. The SORP's big, it's got 303 pages to it, and there's a lot more than we could cover in the time today. So what we want to focus on is certain areas that suit you, because let's face it, I mean, the accountants and the auditors that deal with you at the year end are going to make sure your accounts are compliant, that you do the right things that you need to do. So you'll be in safe hands with them. But in terms of preparation for the year end, there's lots you can be doing in advance. So if you think we're already in that year now, aren't we? We're in the first month of the 12 that are going to run us to next March. And there's information we need to gather now in terms of activities so that you can describe how your activities have kind of panned out through the year when you get to the year end. And there's also kind of, you know, some of the numbers and things that we'll come to that you'll need to collate. So we want to stress this morning why it's so worthwhile to put that time in through the year so that you can put yourselves in the best light when it comes to talking to funders through the accounts. We're going to look at some other hot topics that are in the SORP as well, and there'll be time for questions at the end for anything we don't cover that you want to clarify as well. So the SORP has different requirements for different sizes of charity. We'll look at all the sizes of charities as we go through it, but whether you prepare accruals accounts or receipts and payments accounts, there's something there for everyone. Now with the SORP, it's got 29 different modules. And we want to look at them all in a list so that you've got an idea of what's in the SORP. And then we're going to narrow it down and show you what we're going to focus on. I mean, the SORP's big because it's building on previous SORPs. And whilst it gets reviewed every 5 years, this has been a bit more of an overhaul because There's an accounting standard called FRS 102 that's coming in this year, and that affects companies, charities, and everyone in the UK. So the SORP's been changed to align to that, which is why it's getting a lot more attention, a bit more discussion this year than there have been with other revisions. And there's some new thought in there as well. So if we look at this next slide, it'll show us what all the modules are. And then what we're going to do is rule out the ones where there's not a lot of change. So things like the module on pensions, not a lot's changed. So let's rule those out. And then what we'll do is we'll rule out the ones that are quite niche areas, things that don't affect a lot of charities or don't come up that often. For example, like heritage assets, we don't come across that often. So we'll not spend a lot of time on that today. But again, at the Q&A at the end, if there's something specific you want to ask about, please do. So when we rule those out, we're left with 6 headings that you can see there, and they'll form the agenda for today, which will be on the next slide. So is that okay? Now, I presume at this point you're nodding, but I can't see that because the cameras are off. So what we might try, just for a bit of fun, is on the bottom of your screen, there is a little tab called Reactions. And if you click on that, there might be something like a thumbs up or a smiley face. If you click on that at any point you want, and we might see a reaction, we might not. I don't quite know if the technic's working when it comes to that bit. But now and again, if you want to interact a little bit, that's one way of doing it, apart from the questions. So if you were to look at the SORP, because there may be some sections you want to go away and have a look in more detail, you'll find there's 3 words in there that come up regularly: must, should, and may. Now, if the SORP says you must do something, you have to do it. If you don't do it, then the accounts are not compliant. And if you were having an audit, the audit report would need to be qualified. You know, it wouldn't be a clean audit report if you hadn't done that aspect. So that's must. If it says should, then really you still need to do it. But if you've got a really good reason not to, then that may be okay. It's one to discuss. The accounts are not non-compliant if you don't apply a should, but it's really best practice, and we'd certainly encourage everyone to apply the shoulds. And then the third one, the may, well, yes, that's optional. Quite often there's alternative treatments you can use, or it's just an idea. So that's how we'll treat it when you look at the detail. Now, the other thing that's worth knowing up front is the different tiers that the SORP applies. So different sizes of charity. There's tier 1, which is for charities up to 500,000 income. Tier 2, as you can see, from 500 to 15 million, which is quite a jump. But then there's tier 3 for those over 15 million. You'll also see there that within the 500,000 bracket, there's those who do receipts and payments accounts. And I just want to think for a moment about that, because there's quite a few of you on the webinar today who are in that bracket and might be just thinking at the moment, should you do receipts and payments accounts? Because if you do receipts and payments, you don't need to apply the SORP. Now, I'm not saying you can switch off now, because there's a lot of information we'll cover today, especially in the Trustees report, that'll be really useful for your accounts, whatever size charity you are. And as I say, there's a Q&A at the end. There might be a couple of sections on the leases and income matching that aren't so relevant to receipts and payments accounts, but there is a lot that you'll find useful today. Well, let's just think about receipts and payments, because what they are is literally what goes in your accounts is what goes through your bank account. So if you receive money in that year, it goes in that year's accounts. If you spend money, it goes in as an expense off your surplus, not as a fixed asset, because there's no balance sheet with receipts and payments accounts. So everything goes through costs. Now, of course, the accounts are simpler, going to take less time to do, and inevitably be cheaper in terms of accountancy fees at the year end. So something worth considering. On the other hand, because the accounts are so literal, what's gone through the bank, and there's no timing adjustments, they don't really show the true surplus of the charity, and they really don't show the true funds that you've got available, because you may have committed costs that just aren't being reflected. The other thing with receipts and payments accounts is you can't defer income. So if you say got a 3-year grant this year, you'd have to show all the income in this year. You'd probably show a surplus. But then next year, you may well show a deficit because you've got the costs coming off that project and no income because it's already been accounted for. So that can kind of cause a dilemma at times. And then I just feel like the accounts are less meaningful when the receipts and payments, they haven't got the level of transparency that accruals accounts have, that this SORP kind of encourages to have. So you need to think about who's looking at the accounts. Now, if your income is all self-generated, you may feel like receipts and payments are the best use of the charity's resources and keep it simple, and you're not too concerned about who's reading the accounts. But in a lot of cases, there are people that are looking at the accounts, they're asking questions that perhaps only a set of accruals accounts would answer. So one to think about, talk to your accountants about it if you're considering receipts and payments that you don't do already. Now, if you do receipts and payments accounts, whilst you are bound to having the income and expenditure as it is prescribed, you can still add to the trustees report, and you can put as much as you like in there. So you may take full advantage of some of the recommendations and put a lot more in your trustees report, so you're still selling yourself as a charity and making use of that. Some of the areas of the SORP are not necessarily new, but maybe haven't always been applied very well in the past. So they may be some of the areas we'll cover today. Also, some things in the old SORP were not that clear. So where there's clarification, we'll cover that as well. And then there's areas that were in the old SORP, but were perhaps a should or a may, and have become a must. So they've kind of upped the ante on those, and we'll cover them today. We're not going to spend a lot of time kind of comparing the old SORP and the new SORP just to save time. We'll just focus on what do we need to do now with these new rules. So I'll just ask Paul, what are your thoughts on the SORP?
Yeah, thanks, Peter. I think it's interesting that whilst it is 300 pages long or whatever, it's not actually a full rewrite, but it's a revision. It doesn't add anything that we didn't expect, but it revises what was already there, and it's actually very well written. It's much more detailed than previous versions, hence the number of pages, but that's deliberate from the SORP making team. It focuses on transparency for charities. You know, it talks about extra narrative in the trustees report that we'll come on to. It gives more explanations and more examples, and it really tries to answer the what if questions as you go through it. It's a big positive for me, especially for charities preparing accounts for themselves. The only real downside is that at times it still relies on FRS 102. So it'll say in there, you know, refer to FRS 102 instead of explicitly telling you in the SORP what you need to do. So you've got to really read the two documents in conjunction with each other. But overall, for me, it's clearer, it's more practical, and it's aimed at improving the quality of reporting.
Yeah, thanks, Paul. I agree. When I read the SORP, I thought it was so well written. If there was an award for well-written documents, because we look at a lot of these things to do with accountancy and audit and all sorts, it is quite self-explanatory in a lot of places. Now, I'll just prompt people at this point. When we get to the end of each section, we'll see if there's any questions in the chat box there. Try and deal with them. We'll give it a minute or so at the end of each section to cover questions quickly, but so we don't eat too much into the main kind of content, we'll leave most of the questions till the end. But do feel free as we go along. If there's something springs to mind at the end of a section, we'll try and deal with it then while it's fresh, just before we move on to the next one. Now, there's no questions there, so I will hand back to Paul now to give you some good news for the smaller charities at least.
Thanks, Peter. So just before we move on into the SORP, I'm just going to talk about the thresholds. These have been released by the DCMS, the Department for Culture, Media and Sport, alongside the SORP, but they sit outside of the SORP. And these thresholds apply for periods ending on or after the 30th of September 2026. So for many charities, you'll deal with the SORP first, and then the threshold changes. But in reality, although they're coming in later in the year, because they are for periods on or after the 30th, ending on or after the 30th September, and the SORP applies to periods starting on or after the 1st of January, they're really going to be the same period ends. And for most charities, that's going to be either December 26 or March 27. So changes to the SORP, changes to the thresholds at the same time. So just to run through them, so you'll see the headline one down there is that the audit limit has gone up from 1.1 million to 1.5 million, or 250,000 income last time, with gross assets over 3.26 million, up to 500,000 income with gross assets over 5 million now. So quite a jump in the threshold for an audit, which is good for those charities that were hovering around 1.1, 1.2 million. And the independent examination thresholds have gone up. So for the really small charities, you used to need an independent examination at 25,000 income. That's now 40,000. And then for those in between, previously at 250,000 income, your independent examination had to be done by a qualified accountant. That limit has now jumped up to 500,000. So it's a significant increase, like in the audit one has added 50% on. And it means a lot of charities will now be able to move out of audit, which is a cost saving. You know, it's cheaper to have an independent examination done than it is to have an audit. And like I said, for those charities around 1.1, 1.2 million, you previously would have needed an audit, but now you won't. Just some practical points to look at. So these do sit outside of the SORP, like I've said, and could change even if the SORP doesn't. The rates are different in Scotland, so these are only for England and Wales. If you do have a charity that operates cross-border, then you would apply the harsher regime, the Scottish ones. And just remember that if your funders require an audit, and that's a part of getting some grants, or it's in your article of association, then those rules still apply. You must still have an audit, even if your income is less than 1.5 million. But some good news there, you know, it takes away some of the burden of audit for the smaller charities. Just a quick question that's come in on chat. Are the audit thresholds the same if you're a company or a non-company charity? Yes, they are, because they sit, like I said, they're not company related at all. They're just for charities. So just a little bit on audit thresholds, and I'll hand you back to Peter. Oh, sorry, just another question coming. Who should be the independent examiner for smaller charities with the 40,000 threshold? So if you go over the 40,000 threshold and you're less than 500,000, it can be a suitably reliable person. You know, there's a list out there, and you could go away and find that. And it doesn't need to be a chartered accountant to do that. Okay, over to you, Peter.
Thanks, Paul. So moving on to the trustees report then. This is one of the main areas that will affect everyone, and it's important to look at it now. I was on a training session recently, and there was a speaker there from the Charity Commission, and he was saying, as people involved with the accounts, so yourselves, whether you're accountants, trustees, ourselves as external advisors, anyone involved with the accounts, what a privileged position it is to be in, because the public have entrusted us with their money, and it's up to us to describe how it's been used and what we've achieved with it. And it was just that thought that really, yeah, we are privileged. We want to get it right and feedback that information. So let's, just consider the importance of our roles as we go through this today, because the thrust of the SORP is really about making the accounts clearer to the users. And again, as you read through it, you just see that message again and again, just making it clear and transparent to people. And that's where it builds on the previous SORPs. And maybe it's the least we can do. And there's all that hard-earned cash that's been ploughed into the charities that we describe carefully how we've spent it, what we've done with it. We'll be looking a lot at that today. So not to see it all as just a set of rules we have to comply with, but to see it as something, as a guide to how it can help us convey that message back. It's like Scrabble, which is why we've had it on the marketing visuals and on this slide now. When you have Scrabble, you've got your letters, haven't you? And you have to do the best you can. If you just throw down the first word that you think of, you don't get a high score. And it's like that with accounts, I feel. We've got the numbers, we've got the stories and the activities through the year. It's up to us now to make the best of it we can, not to throw the first thing we think of, but to think carefully. And hopefully by doing that, we get a high score, i.e. putting our accounts forward for funding. Hopefully we'll score big with the accounts and the effort that we've put into them. If you've worked with us, you'll know that we always say the accounts are like a sales document. You don't know who's looking at the accounts. They're there on public display at the Charity Commission, and it might be you send them in with a funding bid. It might be the council looking at your reserves. It might be a wealthy donor who's doing some research before making a decision, or members of the public who are just dipping into the accounts to look at certain things. And we need to sell ourselves through that document. Illustrate what's needed, why it's needed, and what we're going to do with it. And it all starts with the trustees report. And if we get that right, there's more chance of a yes, isn't there, with the funding. We'll talk later about other things that funders look for, but let's delve into the trustees report. I'm going to leave the financial review part for now as well. We'll come back to that later. Let's look at the more wordy parts of the trustees report. So tier 1 to start with. So this is charities under 500,000 income. But if tier 1 has to apply it, so do the tiers above it, 2 and 3. Same way that if a tier 2 requirement, it will also apply to tier 3, but tier 1 doesn't have to apply it. You see what I mean? So all charities already look at their activities and the future plans. So what's new in this SORP? Well, one of the things is the volunteers. Tier 1 needs to give a general flavour of how volunteers are used, the kind of activities that they get involved with, and that's it. Now for tier 2 and 3, there's only a requirement to add in the number of volunteers and more detail on the activities. And there is the option, as a may, of giving the number of hours worked in the higher tiers. Now, this might seem quite onerous, kind of collating this data on volunteers through the year, but funders like to see charities using volunteers. They like to see it there in the accounts. So it can be quite useful to collate that and to include it. The other thing that's kind of new to many is ESG factors. Now, it's an optional, so it's a may for tiers 1 and 2 to discuss ESG, but it's a must for tier 3 charities. So what is ESG? It stands for environmental, social, and governance factors. And there's been a lot of discussion about it, especially the last couple of years. And you'll have noticed it in funding bids, kind of questions about those areas. So just to recap, environmental factors are things like what is the charity doing for the environment? What's the consciousness of environmental factors? What's the culture of lowering energy costs, being carbon neutral, recycling? All those kinds of things come into that. In terms of the social aspects, it's things like the employment practice, the equality, well-being policies, using local suppliers, employing local people. They're the social aspects. And then the governance is more to do with how the charities run. So it's the culture, the ethics, and especially data security, which is, again, quite prevalent in the SORP, talking about your data approach and security. So that's ESG. Now let's look at tier 2, which again applies to tier 3, of course. And tier 2 is probably most of the charities on the webinar today, between 500,000 income and 15 million. So you also need to add in, as well as the things we've just discussed, more details on the aims and the strategy to achieve those aims. And also what criteria you use to measure those. So if you say we have done X, it's like, well, how do you know? Where do you get that percentage from? What data have you used to conclude that? So hence being careful as we go through the year to have the data that we can back up. It's kind of putting more information against the things we say in the trustees report, almost like the kind of things we discuss in a meeting. It's that level of transparency and accountability. So talking about how well activities have helped meet the aims, linking outputs to the activities. And if you have numbers and targets, again, to mention them in the trustees report. You need to refer to positive and negative factors, things that are within your control, things that are outside your control when you're describing the outcomes. And how what's happened in the year will influence your future plans. Again, it's like the kind of things you discuss in a meeting, putting that on paper. So, for example, let's say you said we want to house more people this year, and you haven't achieved it. Not as many were housed. So you could start just by saying that under the old SORP, but now the thinking is, well, okay, well, why didn't that happen? Well, you say, well, the council had the funds available to provide the housing, but we couldn't find the building, prices were going up, and it just didn't happen in time. And so you can say that and tell more of the story. Now, that could be to your advantage. Somebody could be reading your accounts and say, well, actually, I can help out there. I can see the dilemma. I can see what you've expressed. Let me give you some funds and we'll help kind of achieve that. So be thinking about more transparency, more detail behind the achievements. And I think as a practical tip, to think of all this at the end of the year when you're writing the trustees report could be difficult. So maybe when you have board meetings, have a section at the end and say, right, what have we discussed today that would be useful to mention at the year end? Let's just summarize it in a few sentences. We'll catch that on paper. And when we're doing the trustees report, we can go back to these sections and look at the highlights of the year, things where we missed targets or we didn't achieve something. And we've already described what happened in a way that we can kind of relay to the public. And this all feeds into the impact made, which we'll look at again in more detail later. For future plans, I mean, still on tier 2, looking at future plans, you need to include the lessons learned from the past activities and how that influences things going forward. You need to explain the organizational structure. So that might be a diagram, or it might just be narrative to explain how you kind of approach delegating the trustee responsibilities to other, or the trustee activities rather, to other committees, how you delegate to senior management, and giving the reader a flavour of that approach. And that's the kind of thing that you might do once and it could repeat each year. There may not be a lot of change to some of the sections in the trustees report. You need to talk about how you set pay and what benchmarks you use. So again, if you say you use NHS pay scales for your staff, just to say that, and that's the public understand where the pay is driven. And then also explain your fundraising policies. Moving on to tier 3. So in addition to everything we've said for tiers 1 and 2, you also have to look at the performance of fundraising activities and how you spent on fundraising activities, what material expenditure you've put towards it, what's the net return on fundraising. Now this is a little bit more detailed again than we've seen in the past, and that might be straightforward. If you run charity shops, you might say, well, we know what the shop income was, we know what the rental and the wages were, it's easy to match the income and the costs. A bit more difficult when you've perhaps got a fundraising team and there's all sorts of income coming in, especially things like legacies. You might say we've had a really good year on funding, but we've spent the same on the fundraising team. We've had the same kind of inputs and effort on that. Whereas another year, there may be less income and it's outside your control, and it's hard to match the costs against the level of income. So I can see a lot of fluctuation in there, but it requires a bit of thought, doesn't it? What is going to go in fundraising costs category? And it's something to talk about as you go through the year, so that at the year end, you've got that information. You can be talking to the accountants, auditors about what's going in that heading. Paul will explain more later about how the trustees report needs to link with the numbers in the accounts. For ESG and tier 3, again, all that's been said before, but if now you need to include more in terms of KPIs, key performance indicators in the trustees report related to the ESG. Now it gives the option in the SORP to put more on your website and put a link in your accounts as a reference to the website. I'd encourage you to at least put something in the trustees report for those who aren't going to go outside looking further for the detail. And of course, the largest charities, those over 15 million, will already be familiar with doing some ESG reporting. I mean, carbon reporting is a requirement for the largest companies that are charities. So you'll be familiar with a lot of that already. Now, the good news is we're going to send you a list after the webinar. So part of the follow-up material will be a list of what goes in the trustees report for each of the tiers and what's relevant, because there's a lot to take in today. So certainly for the trustees report, we'll be able to send you a checklist, which will help. Back to Paul, unless there's any questions. Does investment income qualify as fundraising in T3? That's a good question. And I'd say not, because there's things around fundraising and there's separate areas about investment income and investment costs. So we may not cover that today, but I'd treat investment income as being separate to fundraising income. And I think there is still a heading for that in the SOFA. Okay, Paul.
Thanks, Peter. So I'm just going to pick up here on the numbers section and the narrative in the trustees report, and like Peter said, making it more clear. So some of the strongest messages in the SORP are about transparency and clarity of the narrative. So what that means is that your narrative and your numbers must really align together, providing that you prepare your accounts on the activity basis. This is one of those sections that Peter said, you know, isn't entirely new, but it's one of those areas that hasn't always been well applied in practice. So, like I just said there, if you prepare accounts on the activity basis, you really need to do this alignment. Now, all charities in tiers 2 and 3 must use the activity basis, but charities in tier 1, that's those with less than 500,000 income, they have the option to choose to adopt natural classification instead. So if you think of a regular set of charity accounts that you see, you see income categorized for fundraising, charitable activities, grants and donations, and then expenditure, you see, again, charitable activities, fundraising costs, etc. What natural classification is it allows the charity to choose its own line descriptions effectively. So instead of having just charitable activities, you could have rent and rates, telephone, salary costs, etc. Whilst that makes it easier for some people to read, because those income and expense categories are just on the face of the sofa. What it doesn't allow you to do is hide any expenditure, because what the SORP says is that if you're applying natural classification, any material balances must be explained in the notes. So you couldn't just lump a whole lot of expenses together just as miscellaneous and have a big number without explaining what they are in the notes. Again, for very small charities, those under 500,000 income, that can be a good thing to do, but again, it's not necessarily what funders are expecting, so you might not want to choose to apply that. Now, for those charities in tier 2 and 3, and like we said, I think that's most of everybody that's on the webinar today. So what you say in your trustees report about your activities needs to clearly tie into what it shows on your SORP. So that means that your income categories, your cost headings, and your activities all need to tell the same story. And that's throughout the trustees report. You know, if you're talking about a charitable activity you've done, then you'll need to see that income for that charitable activity and expenses for that charitable activity in the notes to the accounts. You can't just talk about it and kind of ignore it in the SORP. What that helps with is for grant funders who are reading your accounts to understand a little bit more about perhaps why you're applying for some money, because they might see income for a certain charitable activity is X amount and the expenditure for that is actually Y amount, and you know you're spending more than you're bringing in, so it's going to aid with that ultimately. So what you'll need to do, I think it's easier if you start thinking about this before your year end, because you're going to need to get your financial systems, you know, to be able to track this in place. So what you need to ask yourself is look at last time's accounts. Do you have the right categories? Are you showing more than one charitable activity? If you do more than one, so you might have caring activities, you might have day centres, and they may all run together as charitable activities, and you might just lump them all under one for now. Excuse me. Whereas they might be better separated. Are you grouping your income and expenses in a meaningful way? You know, is it telling the story? Are you being open and transparent with the readers of the accounts? Are you allocating your support costs correctly? So, you know, all the costs for running the charity behind and not doing the charitable activities, are they being apportioned correctly between the different activities? Obviously, having more headings means there's more work because you've got to track all this kind of information in your finance system. But ultimately, like I said, it's probably going to be aiding with any financial bids, any grant bids you're doing, because it helps the reader of the accounts recognise easier why you need that funding, perhaps. So I think it's important that you need to plan this in advance, like I say, and it's difficult to fix it at the year end if you haven't structured your records properly during the year. And that is all, you know, to go in your SORP and in your trustees report. So I'll leave it there, and I will pass back to Peter.
Thank you. So we move on to impact reporting or impact accounting. I love this picture. It's I think a lot of impact is about making people happy in a nutshell. And these look happy, don't they? I just wonder though how many takes they had to get everyone to jump and line up in the same way. I don't know. But let's think about making people happy in terms of impact and what we do as charities. Now, impact accounting, it's always been there. But for tier 1, it's now about looking at the wider general society as well as direct beneficiaries. That's something to bear in mind. Impact, it's more than explaining the activities as we've done in the past. And this is the exciting part, really. This is where you really get to reflect what you do as a charity and pat yourselves on the back almost as you reflect on the year, because sometimes we forget the bigger picture, don't we? We get so bogged down in the detail, we forget why we're really there. And this is where this part comes in. Now, I've looked at the accounts of 20 charities, 10 kind of household names, big national charities, and 10 not so well known, but still between 10 and 20 million income, who you'd expect to be doing a really good job with the accounts. Now, the national ones, they said a lot about the impact they made, so that was good. The others said a lot about what they did, but it wasn't so clear in terms of the impact. So there's definitely can see why the SORP is wanting to bring this in and help charities to convey that better. For example, let me just kind of describe an impact. You might say we ran 10 youth clubs in the area. Great. Why did you run 10 youth clubs? Were they well attended? What were the benefits? Do you need to keep running them, or is kind of mission accomplished? Have the young people that came to them, have they learned to focus their energy on sports and positive things rather than antisocial behaviour, if that was the intention of the youth clubs? Will they go on to teach their children about doing positive things and maybe get involved in similar things in future? So it's this bigger picture and the longer term effects that we're thinking about now. For the funder in that example, they might say, well, was that the best use of our money to run 10 youth clubs? Did it meet our ultimate goal in providing that fund? Could another charity have done something better with the same money? Should they have built a skate park or something completely different that might have achieved the same thing? So let's think about what the funders are thinking. And now we describe the impact, because there's lots of ways to crack a nut, isn't there? Now, this applies to all tiers. For tier 1, as I said, it's for general beneficiaries and the wider public. For tier 2 and 3, it's more onus to look at the longer term. So the next slide gives us a list of kind of factors we can work through. And we want to look at what's the difference between activity and impact, because it isn't straightforward. So first of all, our object. What problem are we trying to solve? And if you think back, it could be many years to when you registered as a charity originally. What did you say on the applications to the Charity Commission? What was your primary purpose? What were the charitable kind of objects that you were looking to meet to become a charity? What were the public benefit elements that you described to the Charity Commission? So think back to those things and what your objects say in your governing document. Then look at your activities. That's what you did. Output, what you delivered. Outcome is what changed then as a result of that for the beneficiaries or the wider public. And then the impact. What's the lasting change, the bigger picture, the longer term? And it's that difference between outcome and impact that's not always easy to differentiate. So let's look at some examples, sticking with those phrases to kind of illustrate it. So for example, activities, we delivered 120 counselling sessions. Outputs, we supported 45 beneficiaries. The outcome, 80% reported improved well-being. What's the impact? Reduced isolation in the target community. So that was probably the ultimate aim, was to reduce isolation, and you work backwards to how you did that. Let's take a youth service charity example. Now, this is an example where the impact might be visible within the year. So for example, 200 young people attended mentoring sessions, 65% improved school attendance, 40% moved into employment or training. Now here the impact is closer to measurable change, but you need to say what difference that made to individuals. So being at school, being in work, and this is where you can tell a story and you can focus on somebody, you can put the pictures in, etc., to now illustrate this. So you might say, for example, John got an apprenticeship for something he'd always wanted to do, and now he's inspiring his friends to study and work, and we can see the big picture and the original dream kind of coming true and the impact being made. And sometimes it's worth it just for a John, isn't it? Or many Johns, and that's why we do what we do. So thumbs up for that and those kinds of impacts as well. Now another example is a cancer charity, let's say, where the impact isn't always seen during the year, where it's longer term and it's less certain. Could be years, tens of years before the real impact's seen. So instead of saying, we cured cancer, if only, you say you can report your progress towards that big aim. So you may describe the grants you were able to award for day-to-day relief, the number of trials supported, the publications that were produced to help identify risks, help people cope with the outcomes, the number of treatments that have entered clinical testing during the year or during a period that you're looking at, maybe the number of partnerships formed and how they've all contributed to the long-term survival improvements. And I know one charity says cancer survival in the UK has doubled in the last 50 years, with charity-funded research playing a major role. So again, it's saying what's happening, not so much what's happened and complete. Or early detection is becoming more common, allowing better treatment. So in other words, it's to report the contribution to the progress, if not the final outcomes. Does that make sense? Hopefully people are nodding again, and you can thumbs up if you like. Now we go to the next slide. As well as using stories that I've described, again, use pictures in the trustees report, use case studies, or even one-off quotes can be really impactful, can't they? Just one line from somebody who's benefited. And then the next slide, in terms of gathering evidence, because remember, to say this, we need to have some substance to it. So, and it makes the task a lot easier, doesn't it, at the year end, if you built it through the year, if you can back up the stats. So look at anecdotes, gather views from participants, do surveys, questionnaires, feedback forms, all things that gather useful information. Look at before and after comparisons, before that project and after it, how the kind of people involved have changed. And also look at non-service users out in the world compared to with your group who did benefit. Look at the national stats compared to your outcomes and how your group have improved so much better. Now for tiers 2 and 3, you need to summarize the measures and the indicators used and KPIs against this, especially if you're talking about numerical targets, numbers of beneficiaries, number of events held, include all of that in the trustees report. And at the end of the day, you need to ask yourself, when you look at the trustees report, could a funder understand what's changed because of your spending? And if that's not obvious, then you just need to strengthen the report. Some reports get very large covering all of this, don't they? And trustees reports can be very large. So one thing you can do, and there's the option to refer to your webpage again and add more detail there. Again, I'd recommend you to at least put enough in the trustees report for the people that are just focusing on that document. But what might be practical is to have an executive summary. If there are a lot of stories and a lot of data, just have something at the beginning that gives a snapshot of it and a kind of summary to pull out some of the highlights and give that impact for those who aren't going to read every page. Okay, I'll see if there's any questions. None on that, so we can hand back to Paul again.
Thanks, Peter. So I'm going to talk now about income recognition, and this is a change to FRS 102, not the SORP, but the SORP does fall in line with it, and it's a change for all businesses rather than just charities. So for some charities, this will be one of the biggest changes coming from FRS 102, and it's probably the area that's likely to have the most practical impact. The key distinction for income recognition is between exchange income and non-exchange income. So exchange income is effectively when you get money for delivering goods and services. And non-exchange income is when you get money for nothing direct in return. So non-exchange income are things like donations and most grants, and income recognition for that is largely unchanged. If we just think about legacies, that's a non-exchange type of income, and the SORP has added some clarification around legacies and the criteria for recognising them. So the old SORP, and hopefully you're all familiar with this, used to say that you recognise a legacy if you've got entitlement, it was probable you would receive it, and that you could reliably measure it. Now, the new SORP has taken away the entitlement. So it says you recognise a legacy when it's probable you will receive it, and it can be measured reliably. And I think this makes recognising legacies a little bit easier, because you're not having to wait for probate now to look at the entitlement. You know, it takes out that legal concept of probate and entitlement, and it kind of wraps it up into the probability assessment. So it might mean now that you're going to recognise legacies a little bit earlier, because you're not waiting. You're not waiting for probate to come through, which is, it can be a very, very timely process, can't it? So yeah, for legacies, I think it's quite simple. So now let's look at exchange income. So like I said, this is when you provide a service in return for money, or you get money in return for providing a service. And what FRS 102 says, there's 5 steps that you must follow now in order to recognise funds at this from exchange contracts. So the 5 steps are: firstly, you've got to identify the presence of a contract with a third party. So am I contracted to provide a service? Number 2, you have to identify the performance obligations in the contract. So does the contract say I will get paid for doing X, Y, or Z? Number 3, you have to determine the transaction price. So what is the price of the service you are providing? Number 4, you've got to allocate the transaction price to the performance obligations in the contract. And number 5, you recognise that income as the charity satisfies a performance obligation. So I think the easiest way to look at this is through some examples. So I've got 3 for you. So number 1, you receive a £300,000 contract to deliver a programme over 3 years. Under the old approach, you probably recognise all that income up front when invoiced or received, and perhaps have it sat in your reserves to be allocated in future years against expenditure. Under the new rules, you're probably going to recognise £100,000 per year as the service is delivered, because you've got a performance obligation. It is to deliver the programme, and it's £300,000 per year, £300,000 for 3 years. So as each year passes, you're going to recognise £100,000 for that service. So that means that your reported income and your surplus is going to spread across the 3-year period rather than be front loaded. So in example number 2, we'll look at a contract that's got milestones in it, and this can be a little bit more complex. So let's say you've got a £120,000 contract over 3 years. It's got 3 phases with payments, linked to milestones. So you get 40,000 on signing, you'll get 60,000 after the delivery of phase 1, which will be after 24 months. You'll have finished doing that, but you'll get the cash in 3 months later, and then you'll get £20,000 at completion. So in this example, you're going to recognise the £40,000 on signing as soon as you get it, because you have because you've completed that obligation, which is to sign the contract. The £60,000 you will recognise in year 2, even though you've been paid for it 3 months after. So you've probably been paid in year 3, but you'll recognise it as accrued income. So it'll go on your balance sheet and it'll go into your SOFA. And then when the money comes in, you'll take the accrued income off your balance sheet. And then for the final part, the 20,000, you'll recognise that when you've completed the project. And again, you've split that 120,000 then over the 3 years, but not in not in proportion over the year. Year 2 is going to have more income in it at 60,000 rather than just 40, 40, and 40. So let's go on to example 3. So this is a more everyday example, potentially. So you run a training program and receive £24,000 up front for a 24-month contract. So under the new rules, you typically recognise £1,000 per month as the training is delivered. Just a question there. Would the 300,000 be treated the same if it was a grant, not a contract? Now, it wouldn't, because grants a non-exchange income. So you aren't providing a service for getting that money effectively. But you'd have to be really sure that it was a grant and not an exchange contract. So, yeah, in all three of these cases, if we can just move on to the next slide. Sorry, move back one. So in all these cases, you might end up with deferred or accrued income sitting on your balance sheet because you've received the cash before delivering the service, or you've delivered the service before receiving the cash. Now, the SORP is clear that, you know, it still doesn't like deferred income where possible. They want you to show it income coming in and you know, your reserves level being higher and then being drawn down year on year. But if you meet these criteria, you are perfectly allowed to defer the income. And if you've got strong justification for it, but obviously meeting this criteria would be that. So just some practical impacts on that. It can affect your reported surplus or deficit, because like I say, in 1 year you might receive 300,000, but you might recognise only 100,000 in this year. So your reserves are only going up by 100,000. It might change your income profile year to year, especially where you're deferring income. You might see that your income drops, and it might then take you out of the audit. If you think back to the thresholds earlier, it might take you out of the audit threshold. Your charity size classification, you might drop down those tiers, you know, that we talked about earlier as well. So if you think this applies to you, the key message is to start thinking about it now. Excuse me, you need to ask yourself, do we need to change our accounting policies? And will it affect your management reporting? You know, do you need to make sure that these changes are being reflected in your management accounts and that the trustees are getting accurate, up-to-date information? So it's not about when the cash comes in anymore. It's more about when you've actually earned it. And that's especially important for legacies, as mentioned earlier. So a question there about if you've got a 3-year contract awarded for March 15th for 300,000, can you early adopt for the March 26 year end? You can early adopt FRS 102. You need to make that clear in your accounting policies that that's what you've done. Or you can, what you can do is you can recognise it now originally when you get it, and then you can either restate the comparatives in the next year, or you can change your brought forward reserves, and there's a different calculation around that, and we can pick that up later. And another question about where do restricted and unrestricted grants receive fit it. So because they're grants, they don't follow this 5-step rule. They just carry on being a non-exchange transaction, just go into the SOFA as normal. So yeah, that's just the changes that FRS 102 have brought in about income recognition. Back to you, Peter.
Okay, thanks, Paul. So let's look at reserves. We always say that reserves are a key area, if not the key area of the accounts. This is your funds at the end of the balance sheet and how you split those. But it's also part of the funding success story in terms of what you present to the public. With reserves, as we say there on the slide, you need to set a target. And now that's targets about sustainability. It's not always 3 months, it could be 3 weeks, it could be 3 years in some cases, that you need to have in reserve to be sustainable for what you currently do. But the other thing is to explain clearly what your actual reserves are compared with a target. Now, not all charities do that, and it's really good that they should, but it wasn't explicit in the SORP. Now it is, and I'm really glad the SORP's brought that in to clarify, so that people will show their actual reserves versus a target and what happens with the difference. If it's not clear when looking at the balance sheet and the trustees report how those numbers tie in, the SORP asks for a reconciliation now as well, which is useful because it's an area where you really need to be clear for people looking at the accounts. Let's just step back and think of a scenario at the moment. You're an uncle or an auntie, and your nephew, let's say, comes along and says, Uncle so-and-so, can I have £1,000, please? I want to buy a car. They just turned 17 not long ago. Now, what goes through your mind when they ask for that? Well, you might think, well, first thing is, have you asked your mum and dad about it? You don't come over and come to me first. Do you need a car? What kind of car are you going to get? Can you drive? What did you do with the money I gave you for your birthday a few months ago? Have you spent it? Why haven't you got a job at the weekend and you could be saving up? Or have you saved any other money? And all these questions might go through, whether we say them or not is another matter, but they might go through our minds. Are you going to be able to afford to continue running a car, even if you get one? The insurance isn't cheap, fuel and all that. So these are the questions we might ask. But as a charity, it's the same when funders look at charity accounts. They might say, but you've already got some money. What are you doing with that? What did you do with the money we gave you last year? Do you need that equipment? Can you get something different? Can you afford to keep it going if you do get it? And these, if you think in those terms, what a funder's thinking about, then hopefully it'll help us be more clear when we're presenting our funds and what we've got in reserve and why we're not relying on that. Have we asked other people for the money? Do people owe us money as a charity? Have we got other companies in the group with intercompany balances that should be cleared before we go elsewhere asking for cash? So all these questions are valid questions from somebody we're asking for money, and we need to make sure they're all cleared so that that doesn't put them off, essentially. So we designate funds, don't we, quite often in a charity, ring fence, earmark certain funds. Now, when that's done, under the new SORP, we need to put a time limit on designated funds. So they can't just sit there forever. We've got to put a time scale on it now. And that'll make us think more carefully about what's in the designated funds. It's really important that we don't overcomplicate the funds. If we're sending our accounts in with an application to a grant provider, and they've got loads of these accounts to look through, they've only got so much time, only so much patience. And if they get confused with the funds and whether we need the money or not, they're just going to pass on to the next one. So let's make it really clear that what we need and why we need it and what we're doing with what we've already got. The other areas in the financial review that I said we'd come back to for the trustees report, just a few points. One is every charity needs to discuss going concern now. So you need to see how your financial commentary ties in with the going concern notes of the accounts, especially the funds and the reserves policy. For tiers 2 and 3, you need to talk about significant events that have affected the financial performance. So say you've made a deficit in the year, what happened to cause that deficit? Think about the principal funding sources and how you've spent them against the key aims. You need to describe key risks as well, but also what you're doing to manage those risks. So again, it's more transparent, saying, look, we know these are the problems we're up against. This is what we're doing about it. Please have confidence in us as a charity. We're sticking around. We're able to fulfill what we aim to do. And if you give us some money, we can make it work. And they're the kind of messages that the SORP's encouraging. A lot of this sounds like repetition. but I think it's because the theme of the SORP, it just keeps coming back again. So it just shows the importance of it. It's putting the numbers against the stories that we're telling in the accounts. For tiers 2 and 3, we also need to explain what investments are held and how those investments were chosen. And now for the first time to say how ESG factors affected our investment decisions. We've kind of seen this coming, but now they're saying in the SORP for tiers 2 and 3, we need to talk about that as well. We need to talk about the legacies, timing, and the impact of our legacy policies on the accounts. And then for tier 3, we need to talk about the factors affecting the financial performance and how it affects the position going forward. And we've seen that before, haven't we? Earlier, when we were discussing the Trustees report, what's happened in the year, but how does that change what we do next year? There's no questions, so I'll pass straight back to Paul.
Thanks, Peter. I'm just going to talk about another change from FRS 102, and that is that how we account for leases. And this applies to all tiers and it applies to all businesses because it's in FRS 102 and not just in the SORP. So the key shift is that most leases are now going to come onto the balance sheet rather than just showing, rent as an expense each year. And it's effectively, FRS 102 is ending the distinction between a finance lease and an operating lease. Finance leases go on the balance sheet, operating leases are expensed through the SOFA. That's not going to happen anymore. I'm not going to cover in detail the mechanics today because we're going to go and we're going to run another webinar specifically about leases because there is that much to talk about about leases. So we'll run through some examples today, which will give you an indication. But like I said, we will be running another webinar on leases separately, and get in touch if you want to put your name down for that. But it'll go out on our socials and everything as well. There's no date for that as yet, but we'll be running it shortly. Okay. So in terms of leases, what's changed is you'll now recognise a right of use asset and a corresponding liability on your balance sheet. So effectively, you're going to increase your fixed assets and you're going to show a commitment to make future payments, which is what a lease is in reality. So your net assets on your balance sheet won't change because you've got a fixed asset increase and an increase to your liabilities, which will net each other off. But importantly, your gross assets might change. And that's important for your audit thresholds. If you think back right to the beginning of the webinar, we said an audit's now required at 1.5 million income or 500,000 income and 5 million of gross assets. So if you are in that bit between 500,000 and 1.5 million income, but you now have to recognise a big lease right of use asset, and it could be property, an office you rent, that you now might have to fall into the audit regime as a result of that. So what I'll also cover off is what happens if the rent isn't at market value. And again, we'll do that in some examples. So the first example is just a standard property lease. So you lease an office for 5 years at 50,000 per year. Previously, you would simply just show 50,000 as an expense each year for rent. What you'll do now is there's a calculation, and like I said, we'll cover that on a separate webinar. There's a calculation to show the net present value of the lease, which you will then show as a right of use asset, and that goes into your fixed assets, which is broadly, roughly, the value of the future payments. And then it's a matching liability for the lease liability. Payments then made for rent each year will go against the lease liability and reduce it, and the property or whatever it is you're leasing will be depreciated, and that depreciation will go to the SOFA. Now, initially, you'll probably see in the first year year, 2 years maybe, you might see a bigger impact on your SOFR than you would if you were expensing the rent directly. But over the terms of the lease, it will come down and it will equalise itself out. So that's if it's a standard lease. So if we move on to the next slide, we'll look at what happens if it's below market rent. So this is a situation that's not, you're not paying the full rent, but you're not paying a peppercorn rent either. And, you know, the next slide after this, the next example is about peppercorn rent. But this is where, for example, you are renting an office and ordinarily it would be £50,000 a year market rent. But because you're a charity, the landlord has very kindly given you a £30,000 a year discount and said you can lease it for £20,000 instead. So what you do in this situation, you still recognise the lease and the right of use asset as if the lease was £50,000 per year, and you add it to your balance sheet on that basis. And then the reduced payments are offset against the lease liability. But what you also do, because the lease is below market value, there's a donated element to that lease. And in this situation, what you'll do is you'll show the donated element as a gift in kind or a donated service and reduce your lease liability accordingly. So because we've reduced that liability by the gift, when you make the payments against it and reduce the liability on the balance sheet, they will end up netting down to nil. And then the third example, like I say, is about a peppercorn rent. So peppercorn rent or nominal rent, you know, usually you pay £1 a year, and you might not ever actually physically pay it, but you pay £1 a year, and these are treated differently because in this case, you know, if you had a 5-year lease and you're only paying £1 a year, in that previous example, you'd end up recognising a massive donation gift in kind at the beginning of the lease. So it might be a 5-year lease. What you do here is you don't recognise a lease liability. Instead, the focus shifts to the fact that charity has the use of an asset at little or no cost. So rather than driving the numbers through lease accounting, what you do is you recognise a donated asset or service where appropriate. So if it's a ongoing lease and it's a building that you're not going to use for the entirety of its useful economic life, and it's not likely that you would with a building, you would recognise that donated service every year. If it was a donated asset that you'd been given and you were going to use it for its useful economic life, so say a printer, for example, you know, a large photocopier printer, scanner type thing, you would recognise the entire cost of that as a donated good at that point in time. When you've done that, we need to clearly explain that within the accounts as well. So in your accounting policies, you know, we rent a property on a peppercorn rent, we recognise that as income in each year. Okay, so if in any of these examples, if there's an option to extend the lease, or indeed the lease has a break clause, then you need to decide how likely it is usually that you would activate the break clause. You know, if you've got a 10-year lease, but the break clause is after 5 years, and you know that you will, or it's likely that you will activate the break clause after 5 years, you do your initial rent calculation, your right of use calculation and liability over 5 years. If at year 5 you decide, you know what, we like it here, we're going to stay here, the charity's not grown as we expected, or whatever, you would recognise another right of use asset at that time. Yeah, let's just move on to the next slide. I'm looking at the time, we're a bit pressed for time, so I'm going to just quickly whiz through this. And like I said, we've got some more, we're going to do another webinar on leases. So just quickly, if the lease is short term, so less than 12 months, you don't need to do a right of use asset. You can just expense that as normal. And if it's low value, so it relates to things like laptops or other small things you might lease, then you can leave that out as well and just expense that as normal. Let's move on back to Peter.
Thanks, Paul. And if there's chance at the end, we'll maybe look at some of them lease questions, because they do have the can get quite involved, but the other webinar will go into a lot more detail. Right, so looking at other funding hotspots, so moving away from the SORP particularly, looking at what other funders look for. So I've looked at a survey that was done recently of big funders and what feedback they'd given on funding bids that they received, looking at what else they look for. And they said for certain types of funders, the accounts were the main document they looked at, over and above the actual application for funding, over and above the website, etc. The accounts is where they put top priority. Hence today's webinar. And the criticisms of some of the funders were quite insightful. They didn't like a lack of clarity in the accounts. Again, things we've been talking about today. They felt that sometimes there was inconsistency between documents. So think about what's in your website, what's in your accounts, what's in the funding bid, what's on the Charity Commission page as well about the charity. These need to align to give them that confidence that the numbers they're looking at are the right ones. I mean, you know so well what you do as a charity, but sometimes it's easy to forget that others don't know exactly what you do. So it's worth explaining that. Also, people not engaging with funders was a criticism. And again, sometimes you might want to just clarify what do they want to achieve with their funds if they give them to you? And if it's not clear, to give them a call and just find that out. And they probably appreciate that interaction. Or if you've been funded in the past, have you fed back to them how things went? And they feel like they've got that relationship with you to be kind of transparent and keep them informed. And these are areas within your control, really, things that you can do and kind of check on as you go along. Another area that they are looking for is sustainability. Again, it ties in with the reserves policy. Are you going to be there to spend this and fulfill this project if they give you the money? After the project's finished, what do you do then? Is there a plan B to keep it going? Do you collaborate with others? Do you work efficiently to get the best out of the resources you have? Strong leadership is another thing that they look for, and a commitment to making a difference. And again, a commitment to seeing through the projects. They like charities to look at the risks and be transparent about the risks and know what happens if something goes wrong, how they will address it so they can continue again. And it all comes back to that sustainable aspect. Now, these factors are more subjective, but things that you can be mindful of when you're putting funding bids in, when you're preparing accounts, that they're also thinking these things. Then the third area, some things that might be outside your control in the shorter term, but you can work on in longer term. So things like, do you have a diverse income? They like to see that. What's your track record and your experience in this particular sector that you are applying for? And how much do you use volunteers? Again, not something you can change overnight, but you can plan ahead for it and be working on for future bids. It's really worth understanding the criteria of the funder as well. Some funders only fund certain things, and that's what they're set up to do. It's no good putting an application in for something that doesn't meet that criteria. Doesn't matter how good the application is. If it's not what they do, then they're not going to look at it. So do be clear on there. And again, it's a criticism from them that so often the applications are things they just don't deal with. This all ties in with measuring the impact, doesn't it? And again, being specific with targets. If you say we're going to help 50 people to do X, Y, Z, that's a lot more accountable, isn't it, than I suppose being airy fairy. So they like that as well. But I think these aspects that we look at, it shows the contribution of the whole team in the charity. The fundraising team may put a bid together, but they need the support of the leadership. They need the reputation of the charity to back it up. They need the accounts people to back it up. And all these aspects that go into it support that team. So you're looking at the whole team in the charity, all contributing towards a successful bid. It'd be useful, actually. I was thinking it'd be good to have another webinar and invite somebody along from one of the big funders to get their insight in what they're looking for when they look at a funding bid, and almost like interview them on those aspects. If anyone's got any good contacts in, the lottery or some of the big names that we hear of regularly as funders, it'd be really useful maybe to let us know on an email or something, and we could try and get in touch with these people and see if we can set something up. Any questions on that? No, not just that one. So let's just do a recap then. As Paul says, we're conscious of time now. We'll leave some time for questions at the end. We've not finished just yet. We've got some hot topics to offer, to cover, and the Q&A, like we say. But just to summarize what we've covered then today. We said in the invitation, I suppose, to the webinar, that would make the accounts rules work for you. Have we done that? We had described how they can work to your benefit. Have we described how you can sell yourself through presentation of the accounts? Have you seen how the Trustees report is so useful, and to bear in mind what's in your accounts when you're thinking of funders and donors and what they're looking for? And as well as being compliant, the accounts need to be clear, don't they, when it comes to showing your income, your costs, and how it all ties in with your achievements. Your accountants will need time at the year end to bring this information together. There's quite a bit of new stuff there to think about, and the format of the accounts are going to change, allocations to review, etc. You can save them time by preparing this during the year, having these conversations, and you leading the conversation to tell them what you've prepared, so that it's ready for them at the year end. And they won't need to charge so much extra, and they won't need to spend time doing things that you could have done, things like the Trustees report. So let's just look at the last kind of list of information to gather. This is almost like a hit list of things to do in preparation for the year end, all things that we've covered today. So have a discussion internally about your aims, what you're working on, how do you know what you've achieved, and what you can do differently going forward. Have that ready for the Trustees report. Track the headline messages, look at the targets you've missed and why, and document that. Look at your KPIs, decide what KPIs you're going to use in the accounts, and how you're going to measure them. Refresh your risk register. Make sure there's something there on cyber security. Look at your volunteer hours, the type of work they do. Look at your environmental goals, and again, how you're going to measure them. And your reserves policy, really important. Make sure that's clear. You know what you need and what's your time scale on spending designated funds. Moving on to the next bit of the list. Look at your organisational structure, terms of reference for committees. It might be a time to refresh those. Look at what costs you're going to put into the fundraising heading. Look at the number of activities you want to show in the accounts. Don't overcomplicate it or make it too difficult, but have enough headings that align to the kind of things you're applying for in fundraising bids. So when you say we do this and this is how we do it, does that tie into what the accounts are and the key activities in your accounts? Look at odd income sources. Most of your income will probably be okay, but there'll be that one contract or that one scenario where you think that's spanning years, it's in different timing, and looking at what Paul's told us, is there anything there you just want to flag up with the accountants sooner rather than later and say, how should we treat this? And so there's no surprise at the year end. Then keep a log of one-off donated goods and services so that you can talk about them in the Trustees report. And last but not least, list your leases, get copies of the leases, look at the fine print, work out what the terms are so they can be accounted for. And if there's options like break clauses or extensions or peppercorn rents and complications like that, minute what your decision is. Get the trustees on board to say, yes, we will continue in this building, or it's a rolling lease, etc. And how many years are we looking at? Get those decisions made to make the job easier at the year end. So I hope that's all been relevant to you, and give us a thumbs up, even better. I'll hand back to Jenny now.
Thank you so much, Peter. So just before we are conscious that we've got a couple of questions in the chat that we've not yet got to, so we do want to reserve some time for those. You will see imminently launching on your screen, we've put together a quick Q&A on a quick SORP webinar poll. So this is multi-choice. We'd love for you to take a couple of seconds to have a look on which of the topics are most interesting to you. Vote for your selection and we can cover off a couple of the hot topics of today and gather some more info. So I'll just give everybody a little moment to read through some of these hot topics and then we can cover them off quickly. So it's already looking like we've got some clear winners for some more info. So I think I'll jump into a couple of those now with Peter and Paul. So highest one by quite a large margin is cash flow statement. If we want to have a quick cover of this before we move on.
Yeah, I'll pick up on this, Jen. So cash flow statements, the SORP has taken this out for all charities below tier 3. So unless you are a charity with 15 million income or above, you don't actually need to prepare a cash flow statement any longer, which for those smaller charities, it takes out that real onerous need to prepare a cash flow statement. The only thing I will caveat it with is in tier 2, income up to 15 million, then if you meet the criteria for a medium-sized entity, FRS 102 will mean that you will have to prepare a cash flow statement as well. So yes, there's a cash flow statement for tier 3, maybe in tier 2, definitely not in tier 1.
Thank you so much, Paul. And just quickly before we run through the questions in the chat, the second actually time with cash flow statement was quantifying volunteers' contribution.
Okay, so again, I'll pick this up. So again, in terms of volunteer time, you don't put volunteer time into your SOFA, and that's because it can't be easily and reliably measured. Okay, so if it's a service that a volunteer has provided free of charge and that service would have a cost, then yes, that would go into the SOFA as a donated good or service. But in terms of volunteer time, you don't recognise that as a cost in the SOFA. And like Peter said earlier when he covered the trustees report, you need to mention it in the trustees report. And as you go through the tiers, there's more information that's expected to be included. So the scale and the nature of the work done, the hours they've done, and you can even say, it's saved us 2 full-time equivalent employees, the number of hours. But yeah, you don't quantify it and put it into the SOFA.
Thank you so much, Paul. So I am conscious of time, but we'd love if everybody's diaries do allow, just to allow us to run over for a couple of more minutes, just to run through some of the questions that have come through in the chat.
Right, so I'll just pick up there were a couple of questions around the leases area. There was one about, does it apply if you're the lessor? No, if you're the lessor, you still account the same way as you did for any properties that you rent out. It's only for the lessee that the changes come in.
Thank you so much, Paul. There was another question on how does this work if we have a peppercorn 999-year lease, please? Is that a module 6? And what is the limit of peppercorn rent?
Okay, so in terms of that, I think I'll pick that up separately with the person that's asked that question separately, and we'll deal with that offline if that's okay.
Fabulous. Perfect. So we have been covering all of the questions as we've been going through. We do appreciate everybody being able to stay on and obviously let us run over for a little bit longer. A huge thank you to our speakers. So thank you to Peter, thank you to Paul for sharing their insights for today, and thank you to everybody for joining us. As mentioned, we will be sharing the recording in the coming days, and I have seen a few people coming through in the chat asking us to share the slides as well. And we'll also send those out with the trustee report checklist that we did mention. For those that are jumping off, we will be sending a quick follow-up email shortly after this, and we'd appreciate any feedback as we are running the webinar, a repeat session of this webinar again tomorrow. So any feedback of how you all felt it went as attendees would be hugely appreciated. And if anybody does have any follow-up questions, Claire will just pop her email in the chat now. So if you do have any questions that you didn't get a chance to answer today or weren't covered, do please reach out, as in our follow-up emails, we'll be sending answers to anything else we get asked. But a huge thank you for today, and we hope you have a wonderful rest of your day.
Well.
Thanks, everyone.